Welcome to vTalkInsight, Risk Sentiment Daily for April 16, 2026. Equities are pressing record highs just as the Middle East energy shock deepens, and that clash is defining risk appetite today. Let us unpack how a powerful AI and earnings narrative is running into increasingly complex macro and geopolitical risks. Risk sentiment today is best described as resilient risk-on, with clear pockets of fragility underneath the surface. The S&P 500 has pushed to record highs, capping a near 10% rebound from last month's lows, and major U.S. equity indices are trading close to session peaks. Volatility has eased dramatically, with the VIX dropping back below 18 after spiking toward 31 during the recent geopolitical scare, and the latest daily gain of roughly 1% in the S&P 500 underlines still strong risk appetite. This risk-on tone is being driven by resilient earnings, an AI-led rally in technology and semiconductors, and continued evidence of healthy U.S. growth and consumer demand. At the same time, markets are looking through intense stress in physical oil markets, ongoing conflict risk around key shipping choke points, and increasingly stretched equity valuations, especially in large-cap tech. Compared with earlier this week, the equity tape is even more bullish, but the same energy and geopolitical fault lines remain in place, leaving this rally dependent on calm headlines and continued earnings follow-through. Resilient earnings and a solid growth backdrop are a primary engine of today's risk-on mood. Global equities have reclaimed and surpassed prior peaks as corporate earnings are expected to deliver double-digit growth for a sixth consecutive quarter, even with elevated oil prices in the background. Wall Street banks are a key proof point. Bank of America, Morgan Stanley, Goldman Sachs, and JP Morgan have all reported record trading revenues, with equity and fixed income volumes up sharply as clients hedge and reposition into this volatility. Beyond the banks, the macro picture in the U.S. is still constructive, with GDP growth projected around 2.3%, supported by robust labor markets and resilient spending from middle and upper income households. Consumer credit quality at Bank of America is improving, with lower delinquencies and charge-offs, and management has lifted net interest income guidance to 6 to 8% growth on the back of firm loan demand. The counterpoint is that some executives, including at JP Morgan, warn credit losses could rise if a full credit cycle emerges, and analysts expect sustained high energy prices to start biting into earnings from the second quarter onward, so the current strength still needs to prove durable. AI-driven tech leadership in equities remains a defining bullish driver. Semiconductor stocks have surged about 20% this month, delivering their strongest 10-day run since the early 2000s, as investors treat the AI supply chain as both a growth story and, increasingly, a perceived safe haven amid macro uncertainty. Companies like ASML have raised full-year sales guidance into the mid-30s to €40 billion range as demand for chip-making equipment outstrips supply, while Meta and Broadcom are committing to multi-year, multi-gigawatt AI chip deployments that support a powerful earnings ramp into the later 2020s. AI enthusiasm extends beyond listed giants, with Anthropic reportedly courting valuations above $80 billion and considering a public listing, and a strong pipeline of AI-related IPOs expected to reshape index composition and sector concentration. However, this leadership is narrow. Recent gains in the S&P 500 and Nasdaq are heavily concentrated in the so-called Magnificent Seven and a handful of AI beneficiaries, while overall market breadth remains weak. There are also execution risks, from power and skilled labor bottlenecks in U.S. data center buildouts to intensifying competition in AI chips that is pressuring NVIDIA at the inference stage, which means any disappointment in this complex could have outsized impact on index-level performance. Supportive credit and liquidity conditions are another important cushion for risk assets. Corporate credit spreads remain historically tight, helped by robust fundamentals and limited net new issuance, and analysts expect this tight spread environment to persist rather than revert sharply wider in the near term. In private credit, institutional confidence is reappearing. A Blue Owl Fund's major bond sale was fully taken down by PIMCO, A Goldman Sachs deal has attracted strong demand, and secular growth in direct lending is expected to continue for years, despite recent stresses in semi-liquid retail vehicles. At the same time, liquidity remains ample, with roughly $22.7 trillion parked in low-yielding cash and money market funds, representing significant dry powder if risk appetite strengthens further. Traditional balanced portfolios are also regaining relevance as rate volatility stabilizes and markets largely price out near-term Federal Reserve cuts, allowing the classic 60-40 mix to recover its diversification properties. The main watch point here is that banks and insurers still hold more than $100 billion of exposure to private credit firms, and while current issues look more about fund structure than asset impairment, any growth shock could expose weaker credits and change this benign picture. Set against these bullish forces is a persistent Middle East energy shock that is reshaping the macro landscape. Shipping activity through the Strait of Hormuz has collapsed from pre-war norms of roughly 100 to 120 vessels a day to just 1 or 2 ships attempting passage, as U.S. naval blockades force merchant tankers to turn away. Physical oil markets are deeply stressed, with dated Brent reported up to $30 above ICE Brent and Brent futures hovering near $95, signaling acute supply tightness that is not yet fully reflected in financial benchmarks. Analysts warn that if disruptions persist for 10 weeks, global oil and product inventories could fall to their lowest levels in over 25 years, potentially driving crude prices above $200, while IEA estimates imply that demand would need to fall as sharply as during the 2020 COVID shock just to rebalance the market. This is already feeding a stagflation narrative. Higher energy costs are hitting Asia hardest, creating demand headwinds, and policymakers in Europe and the UK face an unappealing trade-off between fighting inflation and protecting weak growth. A baseline scenario still assigns a 50% chance to a near-term resolution, but even in that case, most expect oil to grind higher in coming weeks, with restocking needs keeping prices elevated long after flows resume. Elevated geopolitical and policy uncertainty is another key bearish driver that markets may be underpricing. The next day or two are viewed as critical for assessing Iran's response to the current blockade, with analysts flagging heightened risk if asymmetric strikes were to hit Gulf states or U.S. bases, even as ceasefire talks reduce headline violence. Options markets are sending mixed signals. Volatility spiked to 31 during recent tensions, but has since declined sharply, and S&P 1-month puts 5% out of the money are now about a quarter cheaper than before the conflict, suggesting tail risk protection is relatively inexpensive despite unresolved risks. Beyond the Middle East, geopolitical strains and policy transitions are adding layers of uncertainty, from escalating military costs, over $42 billion for U.S. taxpayers in 2 months, to fragile ceasefires that leave shipping routes like the Red Sea and Hormuz vulnerable to renewed disruption. Central bank politics also matter. Markets expect to test any new Federal Reserve chair, with the prospect of early volatility in rates markets spilling over into equities. While in Europe, Christine Lagarde now sees a significant euro area slowdown as the base case, as conflict-driven inflation pushes outcomes away from prior projections. These dynamics help explain why some investors are extending hedge maturities and shifting trading toward liquid index and ETF instruments, even as headline equity indices appear calm. The final major headwind is elevated valuations and concentration risk after a rapid shift from fear to euphoria. The S&P 500 is more than 10% above its late March levels, with gains driven in part by short covering and systematic CTA buying, leaving markets stretched after quick move from oversold to clearly overbought conditions. Under the surface, breadth is weak. Despite index records and an 11-day Nasdaq 100 winning streak, more stocks have been declining than advancing, and only a minority of sectors are finishing in positive territory, while small caps continue to lag large cap tech. There are also questions about valuation excesses beyond public markets, with private assets in some areas having been bid up by abundant liquidity to levels that look rich relative to listed peers, and a large pool of cash still sitting in low-yielding vehicles that could amplify moves if sentiment turns. Some strategists now openly question whether the latest sharp swing from risk-off to risk-on has largely run its course, arguing that the next phase will be driven less by positioning squeezes and more by whether incoming earnings and oil developments can justify current price levels. For portfolios, this raises the risk that any negative surprise on growth, inflation, or geopolitics could trigger a disproportionate reaction in the same narrow set of leaders that has powered the rally so far. To sum up, risk sentiment remains firmly tilted toward risk-on, powered by resilient earnings, an AI-driven tech boom, and still supportive credit and liquidity conditions. Set against that is a deepening Middle East energy shock, persistent geopolitical and policy uncertainty, and stretched valuations with narrow market leadership, all of which leave the current rally vulnerable to negative surprises even as the tape trades near all-time highs. Over the coming days, the key signposts will be physical oil flows through critical choke points, the tone of incoming earnings, and whether volatility and hedging costs stay subdued or begin to reprice latent risks. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.